I do always like to start off the week with a summary of kind of what we saw happen in the week for the S&P 500 and the market as a whole. This is a chart that we've been looking at here for quite some time. This is going back to the very beginning of 2022 for the S&P 500. And you can see that red line there kind of connecting all of those highs on the way down. And then we've had this phenomenal run up. And middle of October is when we hit the low so far. All the way through. Second half of the year last year, market's going to do terrible this year, especially the first half. Earnings are going to be awful. Inflation's going to have a full impact. The impact from the Federal Reserve raising rates is going to have this impact. I mean, this is 9 out of 10 articles, that I'm reading at the end of last year. And even at the very end of last year, the market was selling off. And so it kind of just accelerated those articles. And here we are with this nice run up, and we're going through some very nice, I think, check marks is what I would call these. So one of the things that we look at is what the primary direction is of the market. And what we're really trying to figure out here is when that primary direction is going to change to go to back to up. And I have a checklist that I use for this. So somebody asked me to kind of share that checklist. I'll start with that. I do want to cover our signals and just really quickly kind of talk about that. So the signal right now for our stock market signals is green for both fast and slow signal. And it is on the bond side, we're green with yellow on the slow signal. So, again, what that means from a signal standpoint is just that the fast relates to our clients' kind of tax-deferred accounts, tax-free accounts, IRAs, 401ks, Roth IRAs. And so we tend to make changes a little bit more often because we don't have to account for the taxes in those. We don't have a commission to buy and sell these exchange traded funds that we're using, so that helps. And then the slow is more for these taxable accounts where we don't want as many transactions, really because we're trying not to have as many things end up on the tax return, just kind of a hassle as far as that goes. And so that's what those signals are about as far as that goes. And so, again, getting back to kind of where we're at, let's look at what it takes, in my opinion, to reverse direction back to a primary trend. Okay, so first of all, we've got to break that trend line. So the trend line, this is traditional, is across the tops. And so if you look, you can see we had several big run-ups. Yeah? And so we finally broke through that. And then the second arrow there really is just to kind of show that we actually came back down and challenged that trend line again and held it again. That's not on my checklist, that second piece, but still very important, actually. And so, again, breaking the trend line, good, check, got that done. And then the next thing is just getting through the 200-day moving average. This is classic. This is something that's very heavily talked about. Now, I put in 3 smaller arrows there where you can see where it actually made some false moves through the 200-day moving average and then fell back down eventually. Before the fourth arrow, there's the bigger one. It really broke through, and it's way above the 200-day moving average now. So it's very good. That's really important. The 200-day moving average is on an upward slope. That's another piece of the checklist as far as that goes. So that's excellent. And then there's what's called the golden cross. And so this is when the 50-day moving average, which is that gold line there, crosses up from underneath, up through the 200-day moving average. Again, that's very solidly away from the 200-day moving average. That has a really good track record long term for when markets continue to move forward. And then what we look for is some higher highs. So I circled the red with red circles, the highs that were all lower than each other. So in other words, we had that very big high at the very beginning of this chart, which was at the beginning of 2022. And then we had a big run up, but it didn't get as high. Another big run up, and it didn't get as high. Third one didn't get it. So that's the connection on the way down. But then this year, so that first green circle there, we had a breakthrough where we had a high that was higher than the last high. And the second green circle there, we just did it again. Yeah, so that's really incredible. Those are very important points of kind of that checklist that you're looking for. Then, as of yesterday, we actually ended up with a 20% run-up on a closed basis up at the end of the day. So if you look back in October, when we hit the lowest point and the close there to the close yesterday, we end up with a 20% gain. Okay, so officially, a bull market starts with a 20% gain, right? And a bear market basically starts with a 20% loss. So we actually had a 28% loss from high to low in that downturn. So what that means, at least on a technical basis, is that the bear market is over, at least at the moment. So we'll see what happens and see how this plays out. But it is significant, and it can be kind of psychologically, supportive of those people that are trying to get back into the market, because bull markets average about 5 years in length, right? And the average rate of return is 177% during that time frame.
Yep. So you got a long run for that.
That's right. And so, yeah, that's the hope, right? We're looking at trying to reverse direction here. We've got a whole bunch of things on this checklist. There is one more piece that I would like to see that I've had on my checklist really since the beginning, and that is to break through this high we set back last summer. And that high was achieved on August 16th. And intraday, in the middle of the day, we hit a high of 43.25. Today, just before the show started, we had hit 43.22 at some point today. And so that's really critical. That's kind of a really, I think, important last step here. I wouldn't be nervous about this market with all of the things I've already talked about, but I'm really still holding back on some of the more conservative cash investing money that we've been collecting to wait for that breakthrough to happen. Now, one thing we have seen with breakthroughs in this particular market is usually you get a breakthrough, you get this kind of launching effect. It really just takes off. It doesn't come back. And if it does, it'll come back and maybe just touch that point again and then go. What we're seeing here oftentimes is it actually breaks back down through that trend before it finally goes up again. So maybe that won't happen this time because we're now in this bull market. We're starting to move forward and things are a little bit different. But it's something I'd be aware of, not too nervous about if we get above and get to 43.50 and then fall back down to 4,300 again or whatever and fall back below. That's okay. I mean, that has been okay at least all the way through this run as far as that goes. So good stuff as far as that goes. So I'm going to switch views here so we can see this a little bit better. But just the other things that are important here. Next week, the Federal Reserve is going to be meeting, and they will announce on Wednesday what they're going to do with interest rates.
Yeah, and that's going to be big for the market.
It really is, and I'll show you why here in just a moment. But what I'm showing you here is the core PCE price index, okay? This is the number, right? Everybody talks about all these different things. What the Federal Reserve, when they talk about lowering to 2%, they're talking about lowering core PCE, not CPI, which is what everybody talks about. And so right now it's at 4.7%. And the troubling thing about it is it's been around there for all year.
Yeah, it hasn't really moved.
Yeah, and so it's not coming down as much. However, the market, and I'll show you, this is called the CME group, and they do a thing on what the Federal Reserve is expected to do at each meeting. So this is showing a little hard to see this, but a 72% probability that they will do nothing. They will keep rates at that 5 to 5.25 range.
Yeah.
Good. So, and that's why it's important. So if they raise rates, the market's not expecting that, right? And so, that would be a problem for the market.
Yeah, there's been a couple of surprises from other countries. I think Canada and Australia both surprise raise rates.
That's right. And we saw, kind of a fall off those days too, a bit during those time frames, and mainly because there's some worry that the Fed might be thinking that also. So that's what we'll be watching for next week. Is does this come out to be accurate? So far, this has been pretty accurate. When it gets this skewed, 70+% one way or another, that's pretty interesting. Now, I'm going to briefly jump through the other meetings and the projections. So if you look at the next meeting, which is in July, the 26th of July, the expectation is that we're going to go to 5.25 to 5.5. Right, so that's a quarter point increase. So do nothing in June, jump up a quarter point in July. If we look at September, it's basically saying it stays at that quarter point increase. So basically doing nothing in September. If we look at the next one, which is November, this is very interesting, moving back down.
Yeah.
So highest probability is 5 to 5.25, which is where we are now. So again, move up in July, stay there, come back down in November, and December is expected to stay where it is now too. So if you look at what the market is projecting right now, it's essentially saying we're going to be staying around where we are right now, more or less, for the rest of the year. That's not a bad environment for the stock market as a whole. I mean, that's doable. Would love to see, some health from the economy continue to come through, and the Fed is able to kind of, see inflation come down.
Yeah.
And so we're going to get back into this conversation. The debt ceiling is now kind of off the table for a while. So we're going to get back into this conversation about inflation versus recession, and you really can't have both. I mean, generally speaking, a recession will knock down price, especially price growth. And so that takes away the, inflation. And that's the fear, is that the Fed's going to overraise rates. And the reason that I think the market is somewhat celebrating the fact that they might pause next week is just because the banking situation is still an unknown. The banks, we're not hearing about them as much anymore, which is excellent. But the credit tightening is a cycle that is definitely going to come into play, where banks start to lend less money, and we end up with a scenario where, they create sort of a slowdown all by themselves.
Yeah, it's like a quasi rate increase without actually doing it.
Yeah, and honestly, that's better for the Fed, because every time they raise the rates, of course, they're paying more on the treasuries, right? Mm-hmm. So if the banks, can pull back some and they don't have to raise rates, that's not bad. But the big problem is that they continue to raise rates and the banks pull back at the same time. Those two could create a hard landing, right? Mm-hmm. And so that's what kind of we're watching for. So I think they're looking at the right things. Inflation is still kind of hanging in there, so we'll have to see how that plays out. But that's what we'll be talking about. But the market's doing really quite well. It's pretty amazing. So anyway, that's our summary for the week. I'm glad that you were able to join us today, too, to talk about that. I really look forward to kind of covering this again next week.